Today, we are going to do a very different and unique episode. A lot of people have been asking me in the comment section as well that Shashank, how do we understand market cycles? How do we see what is the best strategy to do when we go through a bad market, when we go through a good market? How do we allocate funds for all of this? How much SIP do I do? Should I stop my SIP? Should I continue investing? Now, yes, there are a lot of questions on how you would manage your portfolio during a bad market. And if you look at our current market today, it is very uncertain, right? There is a lot of ups and downs that are going through the entire market. And whenever the market did a small correction, a lot of us got really paranoid, very scared. And this is something that I want to clarify in this video. So in this video, I'm going to show you a lot of tools, a lot of indicators, and I will explain what you need to do when you see such indicators and how to plan your strategy. So this is going to be an amazing learning episode for you guys. So let's dig in. This is trading view, and look at this, right? I've just highlighted all the times that Nifty has actually taken a correction. If you look at it over here, Nifty has now taken a correction of approximately 17%. Just in the past, when there was Russia-Ukraine, we had a 17% correction again. This is Nifty 50. Even here, if you see in 2015-16, we had another correction of 25% just in the index. Over here, another 25% just after 2008 crash. And in the 2008 crash, which was actually the crash, not a correction, we had around 68% correction from the top. Now imagine being in that situation, right? So markets will always do this. It is not something new. It is not something unique that you will be like, Shashank, you know what, the market's only going to go up. Every time, now and then, the market will always correct. And this usually happens every few years. For example, this was 2008. This happened in 2012. This happened in 2015. This happened in 2020. This happened in 22, 23. This happened in 25. So almost every 2 to 3 years, the market does a correction. Now we know that the market does a correction, right? We know it. It is not something new, and we're aware of all of this. So when we know the market does correction and the market always goes back after the correction, isn't it wise to always plan and understand that, Shashank, how do we plan for these tops? Is there a significant indicator, or is there something that reminds us or tells us that, boss, we are at a top? And how do the big people know that we have reached a top, whereas we are, as retail investors, don't know that we have reached the top? So these are some of the things that I want to clarify today, and we will understand obviously deep down of what is going to happen. Now, before we get in the video, you should also understand that our market has been very volatile, mainly in the year 2025. 2022, 23, 24, we all had shocks, but 2025 has taken the massive shock. But one good thing that has come out of this entire shock absorption is that the participation of domestic institutional investors, which are people like me and you, if you see the SIP inflow data, that has been significantly good over a long period of time. And this is something we have not seen in decades, where DII income is increasing. The DII dominance is increasing over the FII dominance, right? But however, this does not mean that we're immune to crashes, mainly because if DIIs have major amount of stake here, when the market goes into a bad turn, the DIIs obviously will sell off their stake and we will see multiple crashes. So please don't be in that assumption that, okay, Shashank, DIIs are there, now we are safe, nothing is going to happen to us. That is not going to happen. You will see multiple crashes coming in. Now, markets are unpredictable, and we all know that we are in a very weird time right now. And if you want to make a holistic approach, a holistic plan, then you need to have a 360-degree approach as well, right? And this is where you should definitely consider taking other instruments to safeguard yourself, including a term insurance if all of you guys have not taken a term insurance. Now, stock market up and down will keep happening, but I know a lot of you guys forget to take term insurance or renew your term insurance policies, mainly to protect your family's future, because that is something that is very crucial and key. The markets will go up, market will come down, it keeps fluctuating, but you should be prepared for the unexpected if something really wrong happens to you as well. Now, where term insurance comes in is because it's very simple, very affordable. Don't look at it from an investment standpoint. Term insurance is mainly to protect your life, right, and insure your life. So that is where we should look at it. And it is very affordable if you start taking it from a very early age. Now, one of the things that I want to talk to you about is the Axis Max Life Smart Term Plan Plus. Now, this term insurance plan is very interesting because 1 crore life cover starts at 522 rupees a month. Salaried professionals get 15% discount on the regular cover option. They also have something known as a special exit value benefit. Now, basically at any predetermined point, you can exit and receive 100% of your premiums back, which is very unique. Smart cover, because for the first 15 years, you get 150% of the base sum insured, ideal for those who have high financial responsibilities. And also they have a 3-hour settlement claim promise, where for eligible policies, Axis Max Life will ensure claims are processed in just 3 hours. So if you're thinking about term insurance and to protect yourself, then do check out Axis Max Life Smart Term Plan Plus. Now let's get back to the video. Now, if you want to understand when the market is overheated or underheated, there are a few ways we can identify this and understand this, right? The first one, you should definitely look at over speculation. Now, what is over speculation? Now, this is very interesting because if you look at our markets right now, very easily, if you look at the markets, you will see that we have gone up quite drastically in the last few weeks. And whenever at this point, I remember there was huge amount of F&O data coming in. Now, when I talk about over expectation or over speculation, this also means that we are now forward looking at all the Ps. People are getting into F&O trading too much over and above their actual means. And even bad results and good results are not factored in. That is the problem when I talk about over speculation, right? We are looking too far into the future and saying everything is fine today. Ideally, we should not do that. And that becomes a big red flag. Number two, which is the most important, is FII and DII data. Now, for that, you can definitely go check out this free tool called Trendline, where you can go check the FII, DII data. Now, why am I telling you this? And this is very important because if I scroll down, you can look at the monthly and yearly charts over here. Whenever you see FII and DIIs reducing their stake, mainly the FII is reducing the stake, you should be very careful in the market and you should start planning your next steps. And I'll talk about the plan immediately after this. For example, if you see over here, since October 2024, the warning signs were there. They exited. Now they gave us the warning sign here. Even if you had taken the positions out, if you had gone into cash a little bit more, saying, why are the FIs exiting so much? Something must be wrong, right? And they don't come back so easily because they've just exited. And if you look at it very carefully, you would have realized that something is off here and the volume is huge, because if you look at the other places, they've invested also huge, but here the volume was quite high. And here again, that gave you a second indication in November. Even here, if you had gone into cash, maybe 50-60% in cash, you would have safeguarded your portfolio for massive falls that came up over here, right? So this is a very clear indication. And the same thing works with the reversal process as well. What do I mean by reversal process? When you start seeing the buying happening, as you can see, the buying starts happening here, you will start seeing the reversal process also coming in at the same time. So right now, we're still in a selling mode. The FIs have not clearly come back aggressively. And you can see the buying on a yearly pattern. You will see how the buying accelerated here. So from here, we just witnessed something going up really, really good. And here you will again see that a lot of buying reduced. And this was where we had seen the 17% dip coming in as well. So this is a very clear indication. Number three, I'm going to give you another tool to look at where you should understand whether the market is overheated or underheated. That is the Nifty PE ratio chart, which is a long-term chart. Now, this chart from 2001 till 2025 shows you the month-on-month price to earnings ratio of Nifty. Now, it is a very clear indicator. There is no if and buts about it. If you look at the 2008 crash over here, you will see very clearly that in the 2008 crash, you will see that our Nifty had gone up to almost 24, 25, 26 levels. And then immediately we saw a cool off back down to around 17, 18 levels. Again, we went back to 21, 22, 25. Again, we saw the cool off happening. So as you can see, Nifty always operates in cycles, right? So we will see periods of cool off and we will see periods of getting heated up. Right now in 2020, when the whole COVID issue happened, we saw the markets were extremely overvalued. Earnings caught up, obviously, and then we went up. Right now, we've come down to 20, 21, 22, right? Approximately at 20 to 22 range is where we are currently looking at. So right now, we are neither overvalued or neither undervalued. But looking at the new results that are coming out in the market, it doesn't seem like we are really out of the woods yet, or we have gone back into a growth trajectory. So this again becomes a massive problem for all of us. And the fifth thing that you should definitely look at, fourth thing that you should look at is the economic indicators. Economic indicators, this is again available completely free, whatever I'm showing you. Now, economic indicators are again very important because this gives you a very interesting macroeconomic pic. And I know a lot of you guys are not looking at this, right? What do I need to see? First of all, I need to see whether the GDP growth rate is happening, right? The previous was 5.6, now it is 6.2, and there are some indications that it might go to 6.5 as well. And the trend, as you can see, is rising, which is a good trend. That means it is a very interesting thing. Interest rates ideally should go down, but interest rates are rising, so it is not a good trend. Ideally, I want the interest rates to go down as much as possible. Inflation, again, the last one was 3.34. And the previous one was 3.61. Sorry, this has actually gone down. So this is good. This has also gone down. So this is good. And this is going up. This is good. So whenever the GDP is going up, your interest rates are falling down like this and inflation is going down. That means your economy is ready to accelerate and start doing really well. Unemployment rate has also gone down. As you can see, the previous was 8.2 and last is 7.9. So again, this looks very Very, very interesting, right? So these are the things that we need to look at. Government debt to GDP ratio is also something we should look at. And I'll also talk about more indicators towards the end of the episode, which are again very, very important. So ideally, we want the manufacturing PMI to go up. We want the manufacturing production to go up. We want services PMI to go up. We want exports to go up. The exports are going up. So these are all good signs that we are seeing in the economy as of today, that is working really well for all of us. But the same way, again, for all the people who are trying to understand how to look at it from the bear market perspective, everything in inverse. For example, if your GDP rate is going down, right, that becomes a massive issue. So we can't have the GDP rate going down, we can't have interest rate going up, and we can't have inflation going up. And this happened few months ago. This was the case, right, where inflation was rising, your food inflation was rising, interest rate was going up, GDP was falling, everyone left our country and went away, right? Unemployment rate had also gone up to almost 8.2%. So all of these things add up, and you will understand cycle. So now we're actually in the cycle of a recovery cycle, and that is something that is again very, very, very good, right? Now coming back, the fifth indicator that we should definitely look at is the banking sector health. Now I don't know how many of you all remember this, but if you look at our bank Nifty, right, which is basically the index of our banks, it had recently fallen down quite drastically in the month of, from September, the bank Nifty kept falling down. And this is a very good indication of a slowdown. When the banking sector starts looking bad, that's when you know that there is a systemic problem in the economy. And the banking sector starts looking good, that's when you know that there's a systemic rise happening in our economy as well. So right now we see the banking sector going up, so this is good. But in 2024, we saw the banking sector going down, which was a definite negative sign that there is something that might have happened or might have turned. Now, as I said, history never repeats itself, but it rhymes, as what Warren Buffett had said. And this will happen again and again and again. You will see the same things multiple times again and again, right? So it is not something that you should be very shocked or think about. This is something that happens all the time. Now, coming to the plan of action. How do I plan this, Shashank? Now, this is something that we need to focus on. So let us look at how do we actually plan this, right? Now, look at this. The first things first, we have to create something very unique called as a CAP. Okay, we have to create something called a CAP, which is called a crash action plan. Whenever the market crashes, and now we are very clear that, boss, market does go down every 3 months, every 3 years or 2 years, we will see a crash happening, and we know exactly what the indicators are, as you can see here. So we will create something known as a crash action plan. Now, what comes under the crash action plan? That is basically to how do we navigate this entire scenario? How do we navigate this entire scenario in a crash action plan, right? Number one, first of all, whenever we see that these indicators are pinging off really bad, that market is overheated, Nifty P is very high, the GDP ratios are turning, the banking sector is looking bad. If you are invested 90% in the market, start removing that and bring it down to at least 50%, right? Immediately. What's the worst that can happen? The worst that can happen is you were wrong with your analysis and the market maybe takes a small correction and starts going back up. Does not matter. But it saves you from a minus 17% that might come tomorrow. You might lose 3 to 4% in your compounding, which is fine. But you will save yourself from a lot, because that 50% that you do, the 40% cash will be deployed at much lower levels at this point, right? So your compounding again starts growing aggressively. So as soon as you see these signs, go out back. That is your crash action plan. First things first, to start liquidating your cash. Second thing, ensure you have multiple capital that is growing from your income. Okay, this is something that a lot of people don't do. Everyone only looks at their trading capital. I'm talking about your income. If your income is coming in, increase your income to savings ratio, right? Ensure that your savings is much more than your income right now. If you are saving 25%, when the crash is starting, you save 35-40%, you will compound really, really, really well. Okay, then there is another very interesting thing that I want to talk to you about, which is called volatility harvesting. I know a lot of people have not heard about this term, but it's called volatility harvesting, right? What is volatility harvesting? This is for people who do mutual funds. Now, for a person who's doing mutual funds, you obviously can't exit here, enter here, exit here, because your redemption will create problems. You have to wait for one more day for the NAV to adjust. All of that will happen. But when you know that we're entering this, reduce your SIPs, completely reduce your SIPs, wait, and then increase your SIPs once the market starts falling down. And you have to make a plan that every time the market falls by 5%, I will increase my SIP by 15%. Every time the market falls by 10%, I will increase it by 20%. So this is called a crash action plan. And I know it might sound simple, but I know 90% of you don't do this. And that is why the fear of, oh, Shashank, what do I do when the market falls down? So we'll make a plan. Every time the market fell 5%, I will increase my SIP by 5%. One more 5%, my SIP has gone up to 10%. Market fell by 15%, my SIP has gone up to 15%. Why? Because I had stopped my SIP in the past and now I'm doing volatility harvesting. So whenever there is huge volatility in the market, I am sitting and investing at much lower levels, which is actually benefiting me a lot. And obviously the last one, I think all of you guys already know this, which is tax loss harvesting, right? Tax loss harvesting. This usually happens in the towards the month of March. But whenever you feel that you have a nice stock, but you were too late to exit and it falls down, but you know it's a good stock and it will eventually go up, like it's a large cap stock and it's very good, you sell it at a loss, take the loss, okay? Take the loss because you can offset this loss for almost 7 to 8 years into the future and then buy it back again at lower price, and that becomes your tax loss harvesting. So that again saves a lot of money for you when you're investing in it, right? Now, apart from this, let me talk about few more very interesting indicators that you should definitely look at, right? Which signals a problem that is coming into the future. How many of you all have heard of this ratio called the GDP, market cap to GDP ratio? Now, this market cap to GDP ratio is actually Warren Buffett's ratio, which he uses to check in the US market. But we also have the same ratio in India. And remember, I said that the market always, remember that Warren Buffett had said that the history repeats itself, right? Market rhymes. So if you look at the GDP ratio, last 20 years, if I do this, this is how the GDP, market cap to GDP ratio looks like. Look at how interesting this is, okay? This is one standard deviation. What you can see is one standard deviation, right? And you know that according to the principles of mean reversion theory, everything reverts back to the mean. Every time, if it goes here, it goes back to the mean, and this is the mean. As you can see, this 100% is the mean here, right? Now you can see here that the standard deviation 1 is what people are looking at over here. Yes, there are sometimes when it goes to standard deviation 2, but that is horrible. Ideally, we should not go to standard deviation 2 at all. Okay. So coming back to this chart, you can see that every time the market goes above one standard deviation towards this point where the GDP and the market cap is not aligning, right? Where the GDP and basically market cap to GDP ratio is what? That means your Nifty has gone up too much and your GDP is not even caught up. Yes, this is a lagging indicator. It is not a leading indicator because your GDP data comes a little late. But if you are sitting here, whatever lag is there, it is going to create an issue. And this is exactly what happened in 2008. This was during the 2008 crash. Look at this. The whole 2008 problem was created only because of this, because the GDP was not there, but the market cap started flying too much, mainly because of speculation, FOMO. And then we saw the massive crash happening. Right now, we're not there. But we did see this once in 2011-12. You remember that starting, I showed you there was 25% fall. This was around 2015 over here. We saw a small fall. Again, we saw a small fall. This was during COVID. So all of these things keep happening. Right now, we are actually at a bad state. I would not say we're at the greatest state because right now, our GDP is not caught up to the market cap, right? Even if it catches up, we are slightly above the deviation curve. So this is again a very interesting indicator for you to look at when it comes to investing. Another one that I usually look at and something that we all know, we all see, and we all ignore at the same time is your Warren Buffett's cash position. Now, Warren Buffett's cash position, whatever you say and do, he has been right about his timing multiple times in the past. And when you see that Warren Buffett is over leveraging and going completely out of cash, completely in cash, and he's selling most of his positions, he sold majority of Apple, that is when we should take into consideration and say something might be brewing. If he's exiting and taking some cash, it would be wise for us not to fully exit the market, but take some money out and sit in cash and not stay completely invested all the time. That is the next thing. Now, another two more I'll give you, very beautiful indicators. One more is the equity to gold divergence chart. Now, if you go and check Nifty, okay, you can just do this on TradingView itself and you see the line chart. Whenever you see a divergence like this happening, right? A divergence where gold and Nifty does not go in tandem with each other. Now, if you see gold has gone up so much and Nifty is gone here. Earlier, Nifty was above gold. Right now, the gold has gone above this. Same thing happened in 2020 where this went up and this was down. And then we had the reversal coming in here, right? So whenever you see gold and Nifty diverging away from each other over a longer period time frame, that's when you should definitely be careful and say, okay, you know what, something is definitely not good because gold is spiking. That means most of the money is going to an asset class, which is gold, and people are removing money out from here and investing in gold. That becomes a massive issue. Now, coming to the final indicator, which is again a beautiful indicator of understanding when things are going to go wrong. And this is very important for Indian context, is something called deposit growth to credit growth divergence or credit growth to deposit growth divergence. Let me explain what this divergence basically means, right? So if you look at the credit growth to deposit growth divergence, ideally, what this means is credit growth is basically how much lending we are doing, how much lending the banks are doing. That growth is considered a good thing. But at the same time, if that is growing, if lending is growing, then your deposit growth should also be there. right? If the deposit also should be growing at the same time. What happens if the deposits are going down and lending is going up? We are going to create a massive instability in the markets. And this is exactly what happened after COVID, when the markets became so attractive that people removed their FDs and started taking money in loan and investing in the stock market, which became a massive problem for everyone. And this becomes a massive problem for the economy, because if the banks don't have deposits, they cannot lend. And if they lend, they are going to be very stressed, and this creates a massive issue. And if you see this 2025-24 data, this was something that was a big problem, and SBI chairperson had basically said the same thing, that if you look at the divergence between credit and deposit growth is going to be addressed by June 2025, and we are going to solve this. So what do we do here? One, we have to make the stock market less attractive. Number two, we have to make deposits more attractive, and this is exactly what is going to happen. And then the credit growth will also start at the same time. So this is again a very good macroeconomic indicator, mainly from an Indian standpoint, which will help you understand and navigate the market much better. Again, guys, I know this was a very different video from what I do normally, but I hope this really helped you expand your horizon of understanding how the market works. I've given you so many different indicators. What I'm going to do is all the links of all these indicators, I'm going to put it in the comment section below, so that all of you guys can keep this in your watch list, bookmark it and keep it, so you know exactly next time when something goes wrong, what I need to do. Also, guys, please subscribe to the channel, because we put a lot of effort into making such content. And if you liked it, please click on the like button and share this with your friends who want to understand how market cycles work. This is me, Shashank Udupa, signing off, guys. Take care. See you guys. Bye-bye. So if you're thinking about term insurance and to protect yourself, then do check out Axis Max Life Smart Term Plan Plus.